Real quick, I want to show you guys all the confirmations in another trade. That way you guys could see exactly what it is that I'm doing. Alright, so you see how these lines have an amount of space between them. There's like a wide space between them and the stochastic oscillator. What I'm going to do is I'm going to wait for this line to make a bit of a sharper turn, which will imply that it's going a little bit into bear country, or making a red candle is going to start forming. Typically that means that there's going to be a strong reversal. So once to see how the angle is getting a little bit sharper right now. Typically that I think I might have missed it. Wait for it to retract a little bit. Let's see. All right, retract perfectly. All right, perfect. Okay, trade has been placed. All right, so you see how like this line is starting in the stochastic is starting to cross over and bend. A lot of people have been asking me, if you wait for the lines in stochastic oscillator, won't it be too late to enter your trade? If its trend is strong enough, then no. Like if the reversal is strong enough, then no. Because a lot of times it will cross over like at this point of the band. The stochastic will cross over and it will typically be here. So if you're in a 2 or 3 minute trade, you'll have plenty of time to clear. All right. So you see how it crossed the see how it crossed the Keltner channel, the green candle. It was an engulfing candle, meaning majority of the candle was the body of the candle and not wicks. It wasn't spiky. If you see something with spikes, don't even touch spikes. Literally avoid spikes. Like an old video game with the spikes, just avoid spikes. Also, again, see we're in overbought conditions down here in the stochastic oscillator. You see how these lines are starting to cross over? That's a strong indication that you're going to see a reversal. Remember, this strategy is based on reversals. Just focus on focus on being in an overbought market. See, I'm an overbought market. The green candle goes above the Keltner channel. If it goes below, we're going into oversold. All right, and you see how again we're an overbought market right here. And I know I'm repeating myself, but I figured if I repeat myself, you guys will, understand a little bit better. And you see these lines are crossing each other. Whichever direction the blue line is starting to cross, that's the direction of the reversal. So when you see it go down, that means we're reversing down. As you guys can see, I just cleared that trade in a big way. So that's all it is. All right, that's just another confirmation I wanted to show you guys, okay? See this nice big distance between that's just the way it is. Like those are types of trades I like to look for. Nice healthy space. That's usually the first thing I notice. First thing I usually look at is this. I say, oh, are we going up into oversold conditions if it's going down here, or overbought conditions if it's going up here? Are we going into oversold or overbought conditions? Awesome. Is there a healthy space between the blue line and, I guess for you guys it'd be an orange line? I changed the color. Is there a healthy space between the two lines? If the answer is yes, then I go, okay, let's see where the candles are. Okay, the candles are going into overbought conditions themselves. Okay, it was a nice, strong engulfing, bullish engulfing candle. Okay, I'm just going to wait here for this line to make a bit of a sharper turn, because if the line just keeps going straight up, that typically means that the trend is going to continue. Because again, this method, it relies on you going against the trend. It's a very counterintuitive method, if you want to be honest, because you're actually trading against the trend. Your job is to find the reversals and take advantage of the strong reversals. So what you're going to do is you're going to a good way to know that a reversal is coming is you wait for these lines right here in stochastic oscillator to cross. All right, now if the lines are very close together, like see how these lines are very close together here? Let's say the lines are crossing up. I wouldn't enter a trade, because that means that it's not going to be a strong reversal. Let me see if I could find something like that for you guys. Like you see this right here? See how the lines are crossing a lot? Right? And then once the lines open, that's when you see the reversal happen. So once you see so if you do see like a lot of like noise right here, and then the lines open and you're crossing up from oversold conditions, or crossing down from overbought conditions, typically that means that the reversal is going to happen. You see this right here? Another example. Yeah, sorry, it's been so laggy on here. I've been trading on my phone lately. You see these lines right here? See how it's all like crossed and zigzagged? All right, and you see how these lines here, they're just going whichever way. Um, you know, that's it's either two indicators. It either means we're in a very volatile market, or we're in a sideways market like this, which I tell you to avoid. When the market's not really moving up or down, I call it the doldrums. I typically avoid the doldrums because you're really not gonna make any money, because it's literally gambling if you're just trading the doldrums, because there's no rhyme or reason, there's no form of it, you know. Um, Again, I have a music background in sound design, so I guess that's why I took to this pretty well, because I went to Berkeley and I studied. Um, Not to get too much into my history, but I did study, sound design. I'm a musician. I play several instruments and songwrite. So it was pretty much, it was pretty much like, this is sheet music, and these are the sound waves. When you see sine waves, it usually indicates that it's music. See, nice flowing waves. But when you see a waveform and it's just messy looking like this, um, something messy like, yeah, I guess you could say, yeah, messy like, oh man, this thing is so laggy. When you see something that's messy like this, it's typically indication of noise. That's white noise right there. Because that's what a sound wave is. When you hear noise, it's just a bunch of distorted sound waves that don't have any form to them, right? But music, or sound like music, things like that, have proper waveforms. See the sine waves? So when you see nice sine waves, that's when you know that you're in a nice consolidated market. Now, again, the best times to trade, like I said, 3 a.m. or not, actually, I'd say 4 a.m. To 12 a.m. That's when 4 a.m. to 12 p.m. So, 12 a.m. to noon. Oh my goodness. 3 a.m. until noon is when I find the strategy works the best. I don't like it in the afternoon, and I don't really like it at night, until like 11 o'clock at night maybe. But definitely not like 3 p.m., 4 p.m. It's horrible then. You see this again? Noise. Don't even touch that. When it looks like that, don't even bother. When it looks like this, when the lines are just going any kind of way, don't even bother with it. You want nice, clean, straight lines. That's all I can really say. Look for nice straight lines. Yeah, something like this. See that sharp turn right there? That's a strong indicator that it's going to reverse into a down. It's going to reverse back down. See? There it is. See how it reversed? Strong indicator of reversing. I'm just showing you guys because I know this strategy. The part that confuses a lot of people, like when you're first starting it, is it's counterintuitive because we're so used to trading with the trends. What you can do if you use like the alligator, you can trade with the trends with that, like long-term trends. For that, I'd use like 5-minute and above trades. But yeah, let's see. Again, see this, how it's like just going any kind of way. And look at the corresponding candles. It's just noise, white noise. So avoid the noise. Go to where the music is. All right. Again, see that noise. These are doldrums. Don't trade in the doldrums. Trade in clear blue waters, open skies. That's what I always say. Let's see. I like to point out different shapes for you all. You can see. Let's see any more. And again, when I do these like extra videos to my trainings and stuff, I don't put up like a bunch of like quality and stuff. It's just me. Like I get an idea, I just whip out my phone and record it for you. Again, something like this, a long-standing uptrend. Don't do this method for something like this at all. Now you can, because it's still gonna oscillate. See, the oscillator still gives you a good signal like this, a nice clean signal. Then yes, you still can, but it's still very risky because you only have like your entry point has to be perfect because you only have really like 1 or 2 candles, for a reversal. This is actually pretty good though, because the oscillator is so nice of a sine wave. You can see if you would have entered here for a call, you would have been good. You would have had a little bit of time. But a lot of times in these uptrends, I don't even bother because as you can see, something like this, you do a, sorry, I said call before, I meant put, right? So you enter for a put here, put position here. Guess what? You only have one candle before it reverses back up. And then you lose. Likewise here, okay. One candle, okay. But then let's say you enter too late. You lose. So there's not that much room for error when you're doing it in the trending market. For trending, I recommend the alligator. I'll show you the alligator right now. Like if you do want to trade in the trend, a big way to win your trades, I've noticed, and again, I'm not a guru, I'm just someone who's learning, I'm just a nerd, I just study this crap like nonstop for like a month, and I'm just sharing my discoveries with you all. Again, I'm not a guru or anything like that, but you know, I just study. I never purport myself as a guru or a know-it-all. Let me show you this, because I'm not. I'm still learning, you know, I'm still with you guys learning along with you, right? So you see, this is a tool called the alligator, right? So when the alligator is in the doldrums, or even in consolidated markets, what you're going to see is the alligator is just going to be, you know, zigzag lines. It looks like a mess. Again, noise. But once a trend starts, you'll see its mouth opens. See? The mouth opens, and then you would trade in the direction of the mouth opening. So you do an uptrend here. So you do a call. And again, this is a long standing uptrend right here. So as you can see, the uptrend's continuing, and the farther apart these three lines are, the stronger the trend that you're in. So if you're like, oh man, I don't want to do these reversal trades, I just want to trade with the trend. A really good way to trade with the trend is just to use the alligator. And the farther apart these three lines are, the stronger the trend is in your desired direction. All right, and you see how it reversed? See how these lines, they get kind of close together, it gets muddied up again. But it's still trending upward. And again, you see right here, it's muddy. What you have to do is you have to have all three of the lines, you know, spreading apart. See how they're getting closer together? That's because the trend is ending. So this is, see how it's just like muddy. See this? See how the lines are just zigzagged on each other? Just zigzag cross, right? And then, see this is how you know you're in a consolidated market here. The funny thing is these two when I first learned about these two strategy, you know, well, the other one is my strategy, but when I first learned about this strategy, and there was another strategy that's similar to mine, just doesn't have a lot of the confirmations I have, which makes the accuracy really bad. So when I first learned about this strategy and a couple of like the reversal strategies, when I learned about them, I was like, these two strategies, they're like the opposite of each other. How do they both work? See, I was still new, and I didn't realize that they both work because they work in different market conditions. This would not work. This strategy right here will not work in a consolidated market. However, if I were to put back on my Keltner channel, take the alligator off, Keltner channel is perfect. As you can see, a consolidated market, range market. See that? Put, you win. Call, you win. You know, up, crosses up. 2-4 put, you win. You know, and it doesn't cross under anymore, but does cross over again. Do a put option, you win. And then, you know, it cycles back down, and of course, you would wait for the lines here to cross, and then boom, you're going back up, and you'd win for a call option. But then, like maybe an hour or so later, you start to see a downtrend. Something like, where'd it go? I was literally just on the downtrend. Let me see. Oh, I lost the downtrend I was just on. 1 second. Let's see. See how this is a pretty consolidated market. There's not too... Oh, the downtrend's actually in the past. Oh, no, it was a long-standing uptrend. I'm sorry, guys. Long-standing uptrend. Here it is. Was in the past. Got it. All right. So see this uptrend? You need to be like, oh, man, I can't win the strategy because of the uptrend. It's really strong. what you would do is you just change and you just use the alligator strategy. If you could oh, sorry about that. I'm learning that one right now myself. Not even that. Where is it? The alligator. It should be the last one. Okay. All right, but here it's perfect. You see, the alligator is perfect for a trendy market. Because see, the mouth is open. The mouth is the 3 lines. I know it's really hokey, but whatever. So the mouth is these 3 lines. The other 3 lines are open. 1, 2, 3. Because we're in a trending market. But then when we get back to consolidated market, the mouth closes and the alligator is what's called asleep. It's really funny, but yeah. The alligator's asleep here. See, we're in a consolidated market. So what you could do is you could just, cross between the 2 methods because they both work, but they work in different conditions. At the end of the day, all it's about is recognizing the type of market you're in, making sure you follow all of the confirmations, and you're not going to win 100% of the time. I know it's trendy to put 100% winning strategy in like YouTube videos and stuff, but at the end of the day, there's no such thing as 100% strategy. It does not exist. And at the end of the day, the market does do whatever it wants. All we can do as traders is use as many indicators as possible and use as many confirmations as possible to make the best educated trade we can do. And that's why we practice proper risk management. Because trust me, if I wanted to just do 100% every trade, I would do it. Because there's a lot of times I know I'm going to win a trade. And I'm like, oh, I knew I was going to win that one. I should have 100%ed it. But it's good. It's a good practice to make sure that you just stay at, between, 1% if you're starting to 3% or even 5%. Some people do 10% when they're more experienced, but because it's good practice, because that way you don't get into the habit of, oh, I lost a trade, let me double my bets. I lost this trade, let me quadruple my bets, or let me, octuple my bets. It's just more effective, and your account's going to grow when you just decide, trade, small amounts, it will compound. It's a lot better than winning big one day than losing big the next day, having to recover your losses. I follow really big traders, and they don't practice proper risk management. There's one girl on YouTube, and she had this thing where she turned $100 or something like that into, no, it was $1 into $5,000 in one trading session because she was 100% trading it. But then what I found is when I was, in her Telegram group and all that stuff, and her trades and stuff, she had these days where she would be losing, $7,000 because no risk management. So just make sure you practice proper risk management, because no matter how good a method is, no matter how sexy it is to say 100% winning strategy, at the end of the day, there's always a chance that you'll lose. There's always a chance you could get spiked out of profit. There's always a chance that your broker could be lagging. And there's always a chance that the market's just going to go where it wants to go. You can have all the confirmations in the world that something's going to be a consolidated market like this. But guess what? At the end of the day, a consolidated market doesn't last forever. A trend doesn't last forever. Markets do end, But all we can do is do our best to make the best, the best call or put option that we possibly can. If it was 100%, everyone would be doing it. It takes nuance, But that's all it is. Again, I'm not a guru. I'm not anything like that. I'm just a student of the game. All I literally do is study all day long, and I'm just sharing stuff that I learned with you guys. But you can see, alligator would not work with something like this, but it works perfectly with trends. It works perfectly with trends. So I had a couple people asking about what you do in trendy markets, so I wanted to show you. And of course, for this you could do like 5-minute call options. 5-minute call options. If you're in a trend, because even when it retracts, it doesn't retract that much. That's really the only difference between a trend and a consolidated market, is how much the retraction is, or a correction, or whatever you want to call it. Retraction, correction. That's the only difference. See how it only has like one red candle or maybe 2 red candles, but even then they're nowhere. The 3 red candles don't even equal to where this green candle started. So let's say you do a 5-minute trade here, minute 1. Let's say enter here, minute 1, 2, 3, 4, 5. You're gonna win. Depending on your entry point, of course. Here, enter here, minute 1, 2, 3, 4, 5. So when you see something like the alligator and the mouth is open and you know you're in a good trend, that's actually a really good strategy. It's the first strategy I did when I first started trading. And that's the strategy that I used. I took my account from $100 to $250. But then I didn't realize, because I was still new, that a trend market doesn't last forever and you can't use the strategy forever. I actually ended up blowing my account. It was the first time I blew my account. You know, I became addicted to it. I was at the grocery store. Like every aisle, I was like, oh, let me do another trade. So yeah, identify the markets that you're in. I've been like doing a word salad. All right. But that's very important. It is. That's like